looks like it could start negative.
You know, Tara, just one word. When it came out with this previous set of numbers, it was 135 rupees. Now it's around 175 rupees. You know, so from quarter to quarter, the stock has already seen a big rally. So it's trading close to around a 52-week high. And the other problem is sustainability of these numbers. So I think, you know, once we get commentary from the management, we could see some bit of a move even post that commentary. So that's going to be important.
You know, I'm just watching out for these stocks which have been the big gainers this month, right?
Yeah.
The biggest gainers in May have been auto names, M&M and Hero MotoCorp. They've gained anywhere between 13 to 17%. In the last couple of days, little bit of shaving off of positions is what you're seeing. So clearly there's a wave of profit taking in some of these large pockets that have done well. Whether it's M&M, Hero MotoCorp, Divi's Labs have also been one of the big gainers this month, coming off a little bit over there. So maybe that's the order of the day, right? Where you see some pressure in these names.
Absolutely. The question is, will this dip get bought? Because we're starting at those levels where the supports kick in. With the Nifty down about 40 points. So the first tick was lower by about 80. It's already reduced to about a 35-point down tick. And that's how it's trying to find some stability. The Bank Nifty is already looking at some green now. So very, very volatile at the start. Tata Steel down about 3%. That's the first reaction. Nigel, as he explains, probably the stock's already run up and factored in a lot of the good news. What else is weak? Titan starts lower, about 1% down. Tata Consumers, a lot of Tata Group stocks actually on the lower side of the screen as we start off things. Asian Paints is down about 0.5% as well. Wipro, JSW Steel, these are some of the early names. So early trends, one is tech. Tech is slightly weak. LTI, Mindtree, Tech Mahindra, Wipro, a lot of these names are lower. And then you have some of the heavyweights also on the lower side of the screen, like L&T. What's counterbalancing it? The reason why the Bank Nifty is higher because of the big banks. Look at SBI, look at Kotak, look at ICICI Bank, Axis. It's banks to the rescue this morning, negating a lot of the weakness in the rest of the market. And some other stocks, Hindalco, for instance, is finding a bit of positivity. ONGC is slightly positive. But Nigel, it's really all about the banks, and let's see if they can continue. Sonia, looking at the screen right now, about 50 points lower.
Absolutely. You know, you were pointing out the banks, right? But let me take it to individual stocks and how things are shaping up. I think what, investors really want to see is how Tata Steel is shaping up this morning. Strong set of numbers, but the stock is coming in for some profit taking. So down almost about 2.5%. I think Cummins is the one that you need to look at because very strong set of numbers. It's a beat across the board. So given the way the market is moving, Cummins is not bad. Down almost just about 0.5%, outperforming the market right now. Samvardhan Motherson is the other one. There have been upgrades post the numbers, but the stock is coming in for some profit taking. It's had a very steep run up as well. Bata, the numbers were lackluster this time, so the stock is down almost about 1.5%. Edelweiss Finance, we were talking about that one. It's under pressure. The RBI has imposed business restrictions on ECL Finance and Edelweiss ARC. Just look at this, 10% knockdown on Edelweiss Financial right now. Clearly one of the biggest losers in trade. GMR Airports, the losses have narrowed to 168 crores for GMR Airports, and the stock is looking pretty good this morning. It's flat in a market which is down. Lemon Tree Hotels, revenues up 30%, EBITDA up 22%. Clearly the star of the show this morning, given that we have such a weak market in the last couple of days. Lemon Tree Hotels up about 5%. Aadhar Housing, good AUM growth. Disbursements have risen about 20%, so looking good over there. IRB Infra, the promoters may sell up to 4% via a block deal. I think they have, yes. About 5.5% equity has changed hands at 65 rupees a share. So IRB Infra is the one that you need to look at right now. But overall for the market, folks, it's not bad. Of course, we've seen, a bit of a downtick in the last few days, and that continues the downtrend. So let's see how the rest of the day shapes up. I think the saving grace this morning is the Nifty Bank here, down, up about 140 odd points. So really buttressing the fall in the market right now is the Nifty Bank. But otherwise, it's holding on to 22,600. Back to you.
Well, thanks a lot for that, Sonia. A few more stocks that are, the top buzzers today. Edelweiss, as Sonia said, one of the top volume losers on the downside, post that RBI wrap on the knuckle. So that stock's down close to 10%. But to be fair, it's recovered 6% from the low point of the day. KFIN as well, we see a large trade out there that's just taken place, 6% equity changing hands. So that explains why that stock is down close to around 6% to get the block out of the way, as is the case with the IRB Infra. Paytm moves into upper circuit again, one of the top volume gainers in trade today. So that's up and about. Jyoti Structures as well came out with its set of numbers late last evening. And that as well in terms of volume movers, up close to 5%. Genius Power had opened up higher. Let's see where that stock is gone, because the numbers appeared it was a bit of a turnaround quarter. The stock has already seen a big rally for the time being as well. I think Genius Power, it's actually done a U-turn. From the top, the stock is down close to around 5%. GMR Airports, that's another one of those big movers today. The stock has already seen a good move, but those numbers are good. But that's the market for you today. Good numbers. Stock opened up 3%. Now it's as flat as can be. SJVN is another stock that's down close to 5%. I think it came out with a set of numbers overnight, and that stock, in fact, is lower. But as we speak, the Nifty is staging a bit of a recovery. It's down only around 20 points. We started off with a cut of close to around 70 points. So some bit of a recovery. The Nifty Bank, that's the one that's fighting for the bulls as we speak. That's up 250 points odd. So
absolutely. Look at Emami, 9%. So that's a huge mover as well, along with Lemon Tree. Lemon Tree is up 5%. Lemon Tree's story is just great growth and margin compression, but that's because they're growing the business. Like Mangalam was telling us, that they're expanding in their brands like Orica, etc. So that's one stock of the day, and the other, also one tracked by Mangalam, actually is Emami. The gross margin expansion, I think, is something that the market really likes. It's over 200 basis points of gross margin expansion, along with decent growth. And that stock's up about 8-9%. But otherwise, the mid-cap screen is not bad at all. You've got lots of stocks, bouncing around here and there. CG Power is finding some takers as well this morning. There's Paytm, which is up. RR Kabel, which is also in focus on the back of block trades, is also up and about. By the way, the Nifty is now looking like it wants to break even. Look at the charge of the Bank Nifty. 300 points on the upside, and this dip. That first big gap down has been bought along expected lines. The question is now what happens in round 2, round 3 and the subsequent rounds, considering today we also have expiry to contend with. But right now, superb moves on SBI, Kotak Mahindra Bank, ICICI Bank, Indices, Axis, the entire lot. And it has offered a very nice counter to the overall weakness. So that's the shape and the scope of the market. Adrian Moat, sorry, Nigel, you're making...
just one word, as we said, when we wake up to all the negative cues, the markets are nervous. You'll be surprised in 5 minutes the market's almost moved into the green.
Yeah. Somehow that ends up happening, right?
On the Nifty itself. Global cues were weak. The market was nervous yesterday. A lot of unwinding, expired-related factors.
Yeah.
And that was the first few words that we said when we started off the show as well.
Absolutely. But like I said, this is round 1. Yeah. I mean, this has just begun, right?
This has begun.
Yeah. This is the first set. We have a long time to go before it's game, set, match. So let's take it up with Adrian Moat, who is joining in. Is a veteran watcher of emerging markets and, of course, India as well. Adrian, great to have you on the show. There's so much going on, right? There are elections. There's S&P sounding more optimistic on India. Yesterday, we are getting the GDP print. And here is the market, which is practically at all-time highs. How do you feel about India as we get into the big election outcome event next week?
I'm a little bit cautious on India at this point. We've had a very good move over the last couple of years. Valuations were up sort of 23 times forward if you look at the MSCI India level, and that compares to around 10 times forward for MSCI China. And we've had significant outperformance of India versus China, but more recently that's beginning to reverse, and I think that's putting pressure on the international funds, particularly the EM funds, to perhaps adjust those levels. I think the perspective on the election as an event is the expectation that the incumbent government will win a majority. Maybe the size of that majority has been moderating in terms of expectations. But it sort of looks like an event that probably wouldn't generate much upside if the consensus view comes through, and perhaps would have an asymmetric downside if the BJP majority was very narrow, which I think is very unlikely. So I don't see investors looking at the election as something they need to aggressively buy ahead of, if that makes sense. And then when we look through how the market has been performing, you've got a really big spread of returns, and the things that have driven the market, the index, have been relatively narrow, and maybe not some of the traditional stocks that international investors would have held, such as the private sector banks or IT names.
Okay, so you're a bit cautious on the market. Got that, Adrian. It's good to see you after a while. It's been a while since we've chatted. But overall for the market, right, it's quiet, you'd have to say, but the Bank Nifty is really pulling in the punches right now. 230 points higher on the Bank Nifty, making its presence felt, and lots of banks actually batting for the bulls, whether it's SBI, which is your top gainer, Kotak Mahindra Bank, ICICI Bank, Indices, that whole lot is up in the green. Adrian, I wanted your thoughts on banks, because now we're suddenly seeing some of these underperformers come back into the fray, whether it's something like an HDFC Bank, where there has been large delivery-based buying in the last few days. PSU banks are coming back in a big way. Notwithstanding what happens with the election outcome, do you think for a long-term investor, the time has come to put more money to work in banks?
I think it's still a little bit premature. So if you look at HDFC Bank, it's about 2.4 times tangible book value. Its forward P multiple is significantly lower than it used to be. But on a price to tangible book value, it remains one of the world's more expensive banks. Perhaps you find some of the faster growing Indonesian banks with similar price to tangible book levels. So it superficially looks interesting on a forward PE, but there is still this debate about, India is a place which runs a current account deficit, so it has a savings deficit. Deposits are a key ingredient in the banking industry. And in the past, the private sector banks are incredibly good at accumulating deposits much more rapidly than the broader banking system. That's now not the case. I think they've probably caught the sweet spot in terms of the customers that would move towards them. And we're seeing the PSU banks benefiting from, the significant reform that you had with the bankruptcy code, the recapitalization of these banks. And so this trend of SBI outperforming, which it even seems to be doing today, probably continues versus the traditional blue chip private sector banks that the FIs would hold, such as Kotak or HDFC. So I think it all comes back to this competition for deposits in an economy that's growing rapidly and has good uses for capital. And this issue with availability of deposits is a broader issue for the global banking system. And what we see in places like the United States is people putting money into money market funds rather than leaving on deposits. So I think there's a broad global story here that even the top quality banks with high return on capital employed are struggling a little bit when it comes to deposit growth.
Hi, Adrian. Good morning and good to see you. And Nigel on this side. Yeah, the way SBI has outperformed HDFC Bank in the last year or so has been phenomenal. But we started off this conversation by talking about India as well as China. And in China, there are some various policy measures that are helping them and in turn helping metals as well. How do you approach this entire metal basket? Because in all probability, you'll get a couple of rate cuts. It'll soften the dollar. Demand hopefully comes back. And, some of these metal stocks have already priced in most of that. Your view on them?
Yeah, I think people have got a little bit too optimistic on China's demand for commodities. They are doing policy actions with regards to the property sector. But remember, the big issue in the property sector is vacant properties plus partially finished properties. And as they resolve these issues, which are really issues around the financial system, the banking system, in themselves, I don't see them as being a source of significant demand for commodities. So I still expect things like the iron ore price to remain relatively soft. We have seen some strength in things like copper, but that seems to be partly a function of some supply disruption. We've also broadly, we've had a bit of excitement when it comes to M&A in the metals space with BHP putting in a bid for Anglos, although that now seems to have been withdrawn. So that'll be interesting, that dynamic. So I would caution people that are thinking about buying more into the commodity space. I'd be more on the camp that you should be reducing after making some pretty decent year-to-date profits. Okay,
it's a little cautious on metals and on commodities. Adrian, let me just pull out for the bigger picture again. I mean, speaking of China, this year started off with the hope that foreign investors will double down on India because, they didn't do much for the bulk of last year. But that has not played out. I mean, in equities, foreign investors have pulled out close to 20,000 crores of Indian rupees. They've pumped in a lot more money, double that amount in bonds, actually, Indian bonds, ahead of the JP Morgan index inclusion. Earlier, it was about Japan. That was a hot market. Now, what is it? I mean, what do you think is behind this disenchantment that foreign investors seem to be having with India?
So I wouldn't say it's a disenchantment specifically with India. The emerging markets as an asset class have been extremely disappointing, and a lot of that has been due to the weakness in China. But we've also had significant weakness in markets like Brazil, South Africa, which also has elections at the moment, has been very disappointing. That's all going on while the S&P and Nasdaq have continued to make new highs. And I think what we've seen is this global equity money moving out of emerging markets. And India, unfortunately, suffers from that move, even though India's fundamentals are much stronger than the balance of emerging markets.
And do you see that reversing? That's the point, because US markets up until very recently, I mean, look at Nvidia, look at the way the market's moving. So do you see this trade continuing because some other markets just doing so well, or do you see a reversal at all in the second half?
See, I do think there's going to be a reversal, and I'll go back to talking a bit about what's happened in China. So if you look at the large cap names in China in the index, these all tend to be in the tech enabled spaces. So you've got gaming companies like Tencent, you've got the e-commerce names like Alibaba, JD. These companies are announcing significant increases in dividends and big share buybacks. And it reminds me a little bit of the tech names in late 22. Remember, Nasdaq had a terrible 2022. You had significant declines in the major tech names, stocks like Meta being at record low valuations. And in response to this, you got a real focus from the board of directors on shareholder value. And that was the start of the recovery in Nasdaq. I think we're seeing some evidence of that in the big Chinese names. And although we talk a lot about Chinese property stocks and banks, they're a very, very small part of that benchmark. So if you've got these large cap tech names, which tend to have quite a lot of cash on their balance sheet and are more focused on reducing costs and generating more free cash flow, they start to look like attractive financial instruments and can be sufficient to drive the China index higher.
Okay, Adrian, we'll leave it at that. Thanks a lot for joining in. Appreciate your time here on CNBC TV18. By the way, for the market, it is not bad at all. It's the bank Nifty that's really batting for the bulls this morning and making sure that the Nifty stays afloat above that 22,600 mark. The bank Nifty now up almost about 400 odd points. But let's shift focus to Tata Technologies. Reported a steady Q4. The EBITDA margins expanded. Profits after tax slipped by 27% because of higher taxes and lower other income. We have Warren Kevin Harris, who's the Chief Executive Officer and Managing Director of Tata Technologies. Mr. Harris, thanks a lot for joining in and appreciate your time here on the channel. I wanted to talk a little bit about the growth, right? X of VinFast, your revenue growth has been about 10.5% in Q4 and 30% in the full year. What can you guide for in terms of growth in FY25, both with VinFast and without?
Well, good morning, and thanks for the opportunity to join you again. And we were very pleased with the full year results last year, and certainly the momentum that we maintained through Q4. We're very excited about the opportunity that we've got in FY25. There will be a slight overhang from the runoff that we've seen at VinFast that will continue in Q1, but the full year we are very bullish. And despite some of the guidance that our peer group companies have provided in terms of the full year tapering somewhat, we don't see evidence of that. Demand continues to be very strong, and we continue to convert a significant number of the large deals that we have in our pipeline. So we're very confident about the the year that we've just entered.
So do you have any numbers that you can share with us in FY25? What are you guiding for in terms of growth?
We don't provide specific guidance. All I can say is that the momentum that we established last year has continued. We continue to position that we expect to meet or exceed the growth expectations for the full market.
So you may not, sorry, the reason I'm asking you repeatedly is because, we are seeing some signs of a slowdown, especially in pockets like electric vehicles, which is passenger vehicles, right? I mean, if you look at Tesla, they've sort of cut down their guidance. There's a large amount of their workforce that they've laid off. So are you looking at some slowdown because of these, cautious pockets?
Now, I think somewhat counterintuitively, the ER&D cycle, the investment in new product, does not align specifically with the volatility that we sometimes see in terms of consumer demand and unit sales. So companies are investing today in support of their competitive position in 3 or 4 years from now. So we've not seen the impact of the slowdown in the EV growth that is being positioned for markets like the United States. And one of the things that I always remind everybody is that despite the rhetoric that's coming from some companies, the expectation this year is that the EV sales will grow from 14 million units last year to somewhere close to 16.7 to 16.9 million units this year. So although growth is tapering, the transition to alternative propulsion systems continues as expected.
All right. Hi, Warren. Good morning and good to see you, Ben. I wanted the outlook on the technology solution segment because that is a smaller part of your business, but it grew at more than 20%. I think around 23% to be precise. Could you tell us, can it continue to grow at more than 20%? And that's only for that segment. And overall for the company, are there levers in place to improve margins for the coming fiscal?
As far as technology solutions are concerned, we were very pleased with the performance of specifically the education division within that part of our organization. The public sector education proposition that we built here in India continues to grow in a very pleasing way. The central proposition that we represent in that area is the work that we're doing with state governments in and around the deployment of innovation centers for the ITIs. One of the things that we're actually doing is deploying our e-learning platform, I Get It. We are educating students in terms of how to develop concept through the production launch of an electric vehicle. We're partnering with Tata Motors, and we're taking electric vehicles. We're cutting those electric vehicles into sections, and we're able to show the student how the digital product is developed, and also compare and contrast that with the physical manifestation of the product. That approach has been successfully deployed at states like Karnataka. And we've won business over the last 12 months with Tamil Nadu, with Assam, with UP, and the order book continues to grow. So we expect the growth that we enjoyed last year to continue, not just this year, but we have an order book that gives us confidence in terms of our prospects over the next 2 to 3 years.
Okay. So just to expand on this further, what are the kind of tie-ups perhaps that your investors and stakeholders can look forward to? Because you've been announcing several of them, right? There was one with Airbus, there's been one with BMW. I mean, what part of the business do you think will drive the growth that you're alluding to?
Well, I think if we look at the different industry sectors that we support, our primary focus is automotive. That represented over 85% of our services mix next year. Much of the growth and the tailwinds that we're seeing there relates to the transition from internal combustion engines to electric vehicles, and the investment that's been made in software-defined vehicles and connected capabilities. We expect that transformation to play out over the next 10 to 15 years. And so the growth that we've seen over the last couple of years, we expect to continue. And one of the things that we're very proud of is the work that we've done for both traditional OEMs and new energy vehicle companies. And one of the things that's unique about Tata Technologies is the end-to-end capabilities that we have. We still believe that we're the only engineering services organization in the Indian private sector that has developed a complete electric vehicle. And that reputation is affording us the opportunity to build partnerships such as we've recently announced with BMW. We'll be standing up a joint venture here in India with BMW that will be focused upon automotive software and also the development of digital technologies that will help BMW optimize the way in which they run their global operations in the future. So automotive continues to be very strong for us. We're also very bullish about aerospace. Just to give you some numbers, there's about 23,000 aircraft in productive use today. In the next 15 years, that's expected to almost double. And so the likes of Boeing and Airbus can't produce enough aircraft at the moment to satisfy the demand. And so we are very much providing services and capability to accelerate manufacturing throughput within those organizations. And we're also partnering with the group companies, Tata Group companies. As you know, the Tata Group has made a very big investment in aerospace with the acquisition of Air India. It's also invested in capabilities in and around what TASL does, and we're partnering with both of those organizations. So those tailwinds are certainly reinforcing the confidence that we've had in that sector.
So, Mr. Harris, coming back and sort of to wind up with the big picture view, right now, the services part of your business is about 77% of the revenue, right? Technology is about 23%. How do you see this mix evolving over the course of the current year, FY25? And I'm just trying to understand which business typically perhaps fetches you better profits and better margins. And you're at, I think, just about $600 million in revenue, 618 at the end of 24. Slightly longer term roadmap. When do we see Tata Tech hitting $1 billion in revenue?
Well, in terms of our expectations for this year, the split in terms of mix will continue to be about 80-20. The services business is the center of gravity as far as our value proposition is concerned. And as I've referenced before, we continue to be relatively optimistic in terms of our prospects, not just this year, but in the future. But we are addressing through technology solutions a very challenging part of what it's going to take for the manufacturing sector to evolve, which is the development of new skills. And so the investments that we're making in the public sector here in India, we expect to inform content and capability that will reinforce the work that we're doing with many of our customers in the private sector as a complement to what we're doing in services. So we're expecting both of the businesses to grow at about the same rate next year. And we certainly are expecting to continue that as we move into follow-on years. As far as margins are concerned, services continues to provide a much more generous operating margin than tech solutions. But the convergence of our of the business mix is providing again the confidence that we'll continue to improve margins as we move forward.
All right, Warren, thanks a lot for joining in. Wishing you all the best for the coming fiscal. Next time around, we'll try to pull you on some numbers. Till then, wish you well and look forward to chatting up with you. For the time being, slip in a short break. On the other side, we'll focus on RHI Magnesita. Well, I think instead of going into that break, I think we have the management who's standing by itself. Well, we have Mr. Parmod Sagar, the MD and CEO of the company, who joins us. Hi, sir. We didn't want you to wait even for the break. So let's get straight to the action then. One good factor in these numbers is that the margins have improved on a sequential basis. So good on you. Could you tell us, how do you see things panning out for the coming year? In the past year, you had the benefit of a couple of inorganic acquisitions coming into your fold. What is the volume growth you're looking at for this year? And also, you have a peer here in India, which is Vesuvius, which is growing at a rampant pace. What is the market share you have, and do you see that increasing?
Okay, so actually India is growing at about 6% CAGR, and we are expected to grow more than 8%. This means we want to grow with the industry, but also the areas where we are currently underrepresented. Our current market share is about 30%, and we aim to achieve more than 35% by penetrating underrepresented segments like iron making, DRI, pellets, etc., with technological support from our parent company.
Okay, got it. All right. The problem pocket, sir, for you is that asset you acquired from Dalmia. If I just do a rough back of an envelope calculation, it still appears that you're functioning at 50-55% approximately. And margins, I think they are in low teens, maybe 10 to 11% odd. Could you tell us what is the revenue outlook just for this acquired asset? Because the margins are relatively lower. So revenue outlook from this asset and margin outlook just for this one. Yeah.
Okay. As you are aware, there is a significant overcapacity in global refractory market, not just in India. This is due to the broader global macroeconomic factors, like in steel and cement production. Globally, whilst there is a huge pressure on geopolitical factors, there is a bit of stalling in policies of production due to election in Europe, US, even South America. Until there is a steel and cement production and consumption, this global overcapacity in our industry is going to persist. This will lead to significant price escalation due to overcapacity. As we are not guiding on revenue, but on volume side, we are comfortable with a growth of our Dalmia plants around 14-15% and overall around 8%. Our focus is to control controllables, which is our cost, operational excellence, ensure that the margin are similar. At present, our margin is 11.4% of last fiscal in Dalmia plants, whereas when we acquired it was 6.9%. So it is significant improvement in margins, and we are expecting that it should be further improved to that level of 12 to 13% in Dalmia plants.
Okay, got it. So Dalmia, just to get it right, the volume growth you're guiding out there is 15%, right? While for the entire company it's around 8%.
Absolutely.
All right. And for the blended margin, then what would that mean? Because you're going to grow, so operating leverage will play out to some extent. Dalmia will improve as well from around that 11% to around 12 to 13%. So on a blended basis, what should the consolidated margins look like?
I still maintain 14 to 15% on consolidated level.
Okay, all right. What about exports? As you're telling us, the globe itself is going through a bit of a tizzy, geopolitical tensions, demand is not strong enough. Exports, you have plans to scale it up drastically. For this year, what will exports contribute as a percentage of your mix, given the headwinds that we're already seeing?
Our export prior to this last fiscal was about 14% on consolidated level, and now it has come down to 10% in this year. And in the short term, I don't see any, growth in export business because of the reasons I mentioned earlier. So I say maybe after midterm 2 to 3 years time, the growth will come back, and we are expecting around 20% to 25% growth in export in midterm 2 to 3 years from now, not in this fiscal.
Okay, all right. So this year will be a bit of a dampener, but going ahead, you're expecting exports to pick up. Final question before we let you go. Besides the operational performance being a little bit subdued, the other worry for the market is that the Dalmia group has more than 10, 12, I think 13% of RHI Magnesita. And they're wondering whether or not that block is going to hit. Have you heard from them?
No, whenever I happened to talk to them, they never said they wanted to, offload this.
So you believe that they
are happy with that.
So you believe that they'll hold on to this 13%? Is what you're telling?
This is my perception, but Mr. Puneet Dalmia is the right person to answer this question.
Yeah, but we need to ask you as well, since you're saying off and on you speak to them. So I need to put this question to you. And if they are sellers, will the parent look at buying?
I think we are open for any and everything. If opportunity comes, we will definitely look into it.
All right, Mr. Sagar, thanks a lot for joining in. We wish you well. For the time being, in a market that's quite wobbly, the stock actually has been an underperformer the last year. But today, at least, the stock is outperforming because your margins have improved both on the standalone basis and on a consolidated basis as well. The stock is up close to 3% as we speak. For the time being, we slip into a short break. On the other side, we have the management of Samvardhana Motherson, who's waiting for us. Stay with us.
Welcome back. As promised, we have the management of Samvardhana Motherson with us. Very strong numbers by the company. Over 42% rise in EBITDA, 20% improvement in revenues. We are joined by the Chief Operating Officer Pankaj Mittal and the Chief Financial Officer Kunal Malani, who is with us. So, gentlemen, morning to both of you. Mr. Mittal, I want to start with you. You know, overall in FY24, right, the year has ended and the consolidated revenue growth has been 25%. Can you tell us what is the outlook for FY25? Can you do this kind of growth? Can you do better? And what are the demand trends looking like now?
Well, if we look into the basics, you will see that we have been growing both organically as well as inorganically. So this year, both the organic growth and the inorganic growth contributed nearly similar amount, 12.5% coming from organic growth, 12.5% coming from inorganic side. And moving forward also, we are on a very good path, setting up 18 greenfield sites, which will come into operations. We have the acquisitions which have been closed, which are not in the P&L this year, like Yachio. We have done ADI, Lumen, all put together. They will contribute, if we look on a full year basis, all the acquisitions which we have done, they should contribute another 14,500 crores or something like that in FY25. So organic, inorganic, and we are on a very good way towards our Vision 25, which has been for $36 billion. So more things to come in. We see a good future being a powertrain agnostic company. So we don't get so much impacted with the changes which are happening in the market. We supply to all kinds of vehicles.
Okay. So you're saying that the acquisitions will contribute 14,500 crores in FY25. What would that be in terms of growth? What are you looking at? And what will the organic growth be in FY25?
Well, being an OEM supplier, we can't exactly put a number to that. But as I mentioned, that the basics are in place. We are a deleveraged company with very good ratings. So, being acquisitive in nature, customers give us many more opportunity. And that's why we look at acquisitions to also grow. And the companies which we have acquired, they also have very good future in terms of their organic growth. Because when you look into the market, like Yachio coming into the fold, both their main products like the sunroofs as well as plastic fuel tanks, they would see a very good growth. We have very good technologies which came into the fold in terms of our interiors, exteriors. Vehicles are getting premierized, and that holds very good in terms of providing solutions to our customer. And most of these greenfield sites have also come in the emerging markets, most of them in India and China, which are high growth markets.
So just a couple of questions. You said $36 billion continues to be your revenue target for FY25, correct?
That's the 5-year vision which we had set for ourselves. So that's a visionary target which we set, and we always move towards that without just driving towards the top line. So always you would find, Madhusan, keeping a very good balance in terms of how we can be value enriching to all the stakeholders and do the acquisitions at the behest of the customers, where we have the blessings that it gives global solutions to them.
Got it. You were talking about Yachio. Just to follow up there before we head to Kunal. I mean, you have sort of this acquisition has helped you get into different spaces, right? Whether it's sunroofs, fuel tanks, resin products, etc. Are you looking to expand your product portfolio further? And in the on the acquisition side, where would your sights be set now?
Of course, we are always wanting to do something which our customers want us to do. So that's how the whole product portfolio has expanded. And we would not hesitate to do more wherever the customers would want us to get into. Also, you would see that our emerging businesses, they are doing very well. This year, they contributed more than 8,000 crores of revenue. And that's another area. So aerospace, the health vertical, lighting and electronics, all those areas are also growing at a very healthy pace. And we see a good growth in those divisions as well in the coming years.
Just want to sort of also talk about the cost factors. Kunal, if we could sort of come to you. Margins have expanded in Q4, and that's great. But how sustainable is that expansion given the rise that we're seeing in a lot of material costs, particularly metals? What do you envisage going ahead? And what's a steady state margin that you would hope to maintain for the year as a whole, FY25?
I think, firstly, as we have always said, please look at Motherson on a longer term basis. A quarter is not necessarily reflective of much. So if you look at an annualized level, yes, we have improved our performance. And we've always said, please look at the absolute numbers. And on an absolute number, we will continue to grow going forward as well. The number to really focus on is ROC, which we have expanded from 11% last year to 18% this year, if you were to exclude some of the M&As and greenfields that we have set up. If you include them, we are still at 17%. And here we see a lot of traction in being able to further grow this in 25 as well. I think Pankaj mentioned some of the acquisitions which are yet to be embedded into the P&L side. They are there already in the balance sheet side, but the P&L, the full impact is not there. And hence, the 14,500 crores is the minimum that is going to come on the top line side. Other than that, I think the business performance has done reasonably well. The outlook seems decent, and hence we've been able to also recognize deferred tax assets of some of our past losses in this quarter. And that is again reflective of a longer term change that's occurring where many of our units which had challenges in the past, I think a number of the teams done well to kind of improve the performance on a fairly consistent basis. And that's what's driven our ability to then recognize some of these deferred tax assets. So I think all the ingredients are there that we should be able to further propel from here on an ROC. Our target is 40%, so still a long way to go in that regard. But I think directionally we should certainly be able to improve this very well in 25.
Okay. Just a word also on the capex and debt levels and how you're looking at sort of that management. I think the capex plan for this year is 5,000 crores. In the previous quarter, you also pared down some debt. So what's the guidance that you can provide in terms of the debt levels that you'll hope to maintain, the debt to equity? And just maybe a little more color on the 5,000 crores of capex. How will you put it to use?
So out of the 5,000 crores, we've announced 18 new greenfields, 6 of them in this quarter, 12 we had already announced in the previous quarter. So on these greenfields, around about 2,000 crores is what is going to get spent. The remaining is the normal maintenance capex that occurs, or program capex that occurs. So we're looking at something like 5,000 crores plus minus 10% is what we are aiming for, at least in FY25. With this capex, together with some of the cash flow generations, improved performance of the business and so on, I think we will still be on a deleveraging path. So from a debt perspective, if we do not consider any incremental inorganic growth that we do, in our view, the leverage ratios or debt to EBITDA should be somewhere in the 1x odd levels, give or take, by FY25. So overall, I think there are again many levers of cash flow generation with some greater degree of stabilization coming on the working capital side. Stuff like commodities, etc., to us is a pass-through. Yes, they have gone up, but from a lag perspective, they become pass-through. So overall, I think again all the ingredients are there that we should be able to deliver from here on an organic basis, in spite of all the higher capital that we are doing for growth.
Okay, so you said debt to EBITDA should be in the range of 1x, right? Your net debt is now at 10,300 crores. That's a drop of almost 18% quarter on quarter. What do you expect the net debt to be by the end of the next year?
As I said, we don't want to hazard a guess on this. As I said, it is 1x, so it becomes very easy to look at what it is likely to be. But I would just say that it's a direction where, in spite of all the incremental capexes, in spite of, inorganic growth opportunity, the sector that we're looking at, our leverage ratio remains fairly, good and has the necessary, let's say, the firepower now to go after the incremental growth that we are looking at in FY25. The direction on 1x is to highlight the fact that there is a lot of headroom, and for sure we are inundated with a fair amount of M&As, and hence it is, and that's the reason why I don't want to give necessarily a number out, because inorganic growth will still be part of the puzzle as we move into FY25.
Okay. So, the strongest growth, Mr. Mittal, I want to come to you on that. The strongest growth has been in the emerging businesses, and it's interesting there, not just revenue growth, which has been about 18%, but EBITDA growth. The operational performance has picked up a lot in the emerging businesses. I want to understand 7% of your revenues comes now from emerging businesses, both auto and non-auto. How much can you grow that to, and is there scope to grow margins further in that space?
Of course, I mean, these are emerging businesses and they are poised to grow at a much faster pace as we move forward. As you know, we have also announced the acquisition of ADI, which is into the aerospace side. So we do see very good traction from our customers for these emerging businesses. And you will see that the next 5-year plan will also see a huge growth coming from these.
Okay, got it. So when you say huge growth, how much can you take it up to? I mean, can it contribute 10%, 15% of your business?
No, I mean, it'll be much faster in years to come because these were the new businesses which were embedded. So obviously, when they are smaller and then they grow, they will definitely grow at a good pace.
Okay. And, I wanted to know on EVs as well, right? That's been the mega trend where the share of hybrid, share of EVs has gone up in the portfolio, not just for you, but for the entire industry. 23% of your automotive booked business is from electric vehicles now. How much can you take that up to, and will that help you further with your operational performance? Kunal, I want you to come in on this.
Look, I think on an EV front and on hybrid front, we've been, so number one, I think we are powertrain agnostic. So irrespective of whatever powertrain sells, from our perspective, it works well. Obviously, in an EV or hybrid, the content increase is much higher, and hence it is helpful to see the transition happen. Having said so, I think from an EV perspective, while the growth continues, the pace of growth clearly has ebbed lower. And hence the share of revenues that were being expected from EVs, I think that share hasn't happened as much as what the expectation was. But from our perspective, ICE hybrids continue to sell, and hence it really does not matter from an aggregate perspective. Hybrids, on the other hand, in our view, seems to be catching a lot more fire now, and hence, we expect that share to move in many parts of the world as an intermediate point between becoming completely zero emission from an ICE engine construct. So overall, I think all three is likely to do well, at least in the shorter term. And then I guess we need to see how the technologies evolve to see what other opportunities exist. But again, just want to highlight we are powertrain agnostic, so really does not matter in the aggregate scheme of things. And the other piece I think which is worth noting is clearly the premiumization on the developing part of the world continues to be much higher. Places like India, China, I think continues to rocket higher on the premiumization front on SUV usage and so on. And that again carries a lot of content increase for us. So overall, our portfolio and geographic mix should be able to propel the growth from here on as well.
Okay, all right. We will leave it at that. Thanks a lot for joining in. Appreciate your time here on CNBC TV18. Well, let's do one thing. Let's slip into a quick break. On the other side, we'll have the metal analyst Rahul Jain put focus on Tata Steel's Q4 numbers and what you should expect from there.
Welcome back. Well, the markets have taken out the 22,600 odd mark. So that bit of a bounce that we saw, that quickly got sold into. The Nifty bank, though, that's holding one end up with a gain of around 250 points. Positioning is very, very light over there, as we were telling you earlier. Rollovers are much lower than what we've seen in the past. So that one's a lighter index for the time being. It's doing a bit of an outperformance. But Tata Steel, that's one of the top losers on the Nifty, in fact. But the numbers look pretty okay. We have Rahul Jain, who joins us on the show. Hi, Rahul. Good morning and good to see you. Well, the stock is pulling back close to around 4%, Rahul. What did the street like about the numbers? Or do you think it's market sentiment that's swaying? Because that's not the only steel stock that's down. The other ferrous names as well have come in for some profit taking. Your take?
Yeah. Hi, Nigel. The numbers were pretty slightly weakish, I would say, because largely due to pricing. So steel prices on a year-on-year basis for Tata Steel is lower by about 8%. And QOQ is about by 4%. So that is actually dragging the numbers lower. Volume, they've done fine. They have shown some growth. Obviously, the next kicker will come from when the new 5 million ton expansion that they're doing. And on the cost side, also things were pretty all right. So if you see, despite weaker pricing, they've managed to hold on to the EBITDA. The EBITDA per ton is only slightly weaker. So in that sense, the numbers are not that bad, obviously, but pricing is the key element. And we have seen prices go up in the recent quarter. In the Q1, we can see a significant, or almost about, companies have been talking about 5 to 10% kind of a steel price increase, and costs are kind of benign. So the outlook in going forward is much better.
I'll be speaking to the management in a couple of hours from now, or maybe 90 minutes from now. And if that 5% price increase comes about, I don't know whether demand's strong enough, but that'll be music to the ears of the bulls. But you mentioned that the numbers are a little lower than your expectations. We go through a lot of brokerages with regard to the India EBITDA per ton and the Europe EBITDA per ton. And in comparison to that, actually the numbers for India was more or less in line at 15,000 rupees per ton. And on Europe was much better. What were your expectations?
Yeah, Europe, actually, they have managed to cut down the losses. Over there, things are slightly better. India, obviously, because if you go by what the numbers other companies have reported, they have done slightly weakish in the sense the pricing hasn't been that robust. So that I think that taken care of by how market moves from here. So I think the key commentary here is when are they going to commission the 5 million ton? They've done a lot of capex. So how that shapes up here.
So you're not going to be a buyer into this dip on Tata Steel, right?
Yeah, I think their growth profile for some of the other companies is a lot better, largely because of the base level, especially, for example, if you see Jindal Steel and Power, their capacity expansion is almost doubling from here, So the profile is very different. Tata Steel, certainly good. They have their issues in terms of, getting the UK operations on stream and reducing the losses in the international operations. Debt level continues to remain a bit on the higher side, about more than 75,000 crores. So Tata Steel has a lot to work on the balance sheet as well as the international operations. So those are the slight issues which I see over here.
All right. And JSPL, they've got a couple of triggers for them as well, right? Capacity is going to be increasing. They're getting some coal from their captive sources as well. And that political uncertainty for the time being seems to have been put to rest. And that explains why that stock has moved up. A quick word on the non-ferrous space. A couple of calls you have got bang on with regard to Vedanta as well as Nalco. I think you were quite bullish on both those two names. Both those two have seen some bit of a pullback, particularly Vedanta from the recent peak.
Right.
Any view on that name?
So Vedanta, especially the one is that they are going to announce a breakup. The details are yet to come out, and non-ferrous prices have been very robust. So if you see across the board, the key metals for them, aluminium and as well as zinc, both are more than 5 to 10% in the last quarter. So that is a very strong driver, and also if you see the change in earnings is far massive, because what happens is they also have coal, captive coal coming in. They have the bauxite integration is going up. So things are improving very significantly over there. And obviously they were trying to raise some money so that they can lessen the debt burden much faster. So that the balance sheet changes very fast, and commodity price drive also is quite strong. So they have two massive tailwinds coming in their way, which can really alter. So if you even look at the value today, it's about 450, whatever order the stock is trading at. Hindustan Zinc holding itself is at a similar price. So in a sense, they're getting all the other businesses at kind of a very discounted price. So with over time will get discovered. I think they've had issues in the past. So as things get resolved, we can see a significant uptick from here as well.
I just wanted to get your sense on, from here on, what would be perhaps one or two of the best metal stocks to play? Because if we just look back at historical trends, some of the PSU metal names have done very well because they have the added tailwind of, the PSU buzz. So SAIL, for instance, has given double the returns of Tata Steel in the last 1 year. And then this underlying sort of, trend on aluminum, which has been very, very bullish, that's really helped NALCO, along with the fact that it's a PSU. So going forward from here, what would you bet on, ferrous or non-ferrous?
So the characteristics of ferrous is actually a lot better because you have costs which are going to come down. Especially see ferrous, see for example, Hindustan Zinc is a cost leader, right? They're more than 50% EBITDA margins. So really can't do very dramatically over there. But for aluminum players, the swing can be quite significant. The costs don't go up. For example, in steel, the slight issue is that whenever you see steel price going up a lot, you see coking coal, prices also start moving higher. So the bargaining power is much lesser in that extent. Whereas in case of aluminum, most of the coal is sourced domestically, or even if it is imported, the costs don't move, in line with the end commodity price. So you end up keeping most of the margins. So that is a positive trade we have over there. And in case of non-ferrous, the drivers are also similar, but non-ferrous in case more so for EV replacement and for climate change transition. Those things are and aluminum has come as standout metal, especially after COVID, due to the very high the recycling capability it has. So that has done well. The underlying drivers obviously remain very similar. Transportation and construction is more than about 50-70% of the demand. So that those remain the same for steel as well as non-ferrous. But non-ferrous metal companies in India are definitely slightly better placed compared to the steel producers. Obviously, steel individually stock specific, like I said, for example, you mentioned about PSUs. So in case of PSUs, the lot of inefficiency is there. For example, if you see the EBITDA per ton for SAIL, it is far lower compared to JSW or Tata Steel. So even if there's a small improvement which they're able to work through, that makes a huge difference. And see, on terms of the physical assets, SAIL is unbeatable. They have 5 locations. They have full captive iron ore, but obviously they have not been able to ramp up the production in the same manner. They've taken far longer to increase the capacity. Now they're talking big numbers, but the faith of the market is less in terms of the timelines, obviously, because they have not been as efficient in terms of adding capacity. But those things can change. Obviously there is, as you have better management drive, more accountability, things can look better. So PSUs are definitely, they have very positive characteristics. For example, in case of even NALCO, they are the only one which have, adding alumina capacity. So those things are definitely there. Yeah.
Okay, thanks a lot for that. Thanks for taking the time out. By the way, for the market, the Bank Nifty is still holding up, but the other, part of the market is not. So the Nifty is now down 140 points. Sensex is down 420 points. It is getting worse by the hour. Just keep an eye out on that. Very, very volatile right now as we speak. But Imami is firing up in trade. Mangalam is here with more details on that. Mangalam, over to you.
Well, the company reported their numbers around 3:10 yesterday, and as a result of the volatility in the market, the street did not pass through these numbers. But some overnight assessment and commentary from the management, and that's taken the stock higher today. It's extended winter in the fourth quarter that aided sales in their winter portfolio. Domestic business for them grew 8% with a volume growth of 6.5%, which is among the highest that we've seen in the FMCG industry so far. Gross margins improved, and the company ramped up their ad spends as well to about 20% of sales versus 15.5%. All of that doing well for them. So overall, the revenues of the company grew around 6.5%. The EBITDA grew 5.5%. That's because they spent a lot more on advertising this time around, and the net profit too was stable at around 147 crores. The categories that did well for them, the winter categories. So you had Boro Plus, which showed a growth of 33%. Healthcare, which has Chyawanprash, that is typically a winter product, grew about 10%. And we saw some weakness in Navratna and Dermicool because Jan and Feb were still colder than what usually it is. So, and that brings us to the big trigger to track now will be the performance of summer products as we are talking about the heat wave. And it's the first full summer that the company will have for its acquisition of Dermicool, which it made in March 2022. And thereafter, the March 2023 summer was largely impacted by them scaling that business up. So all these factors coming together, the future looks good for Emami, and the stock trading at 28 times is a lot lower than all the other consumer staple companies as well.
Okay, all right, Mangalam, thanks very much indeed. Emami is doing very well in an otherwise extremely weak market. The fall, by the way, is now a whole 150 points on the Nifty. We're at the morning lows. So that opening sort of dip happened, then the buying of the dip happened, but then we've got a second dip. And this one's looking pretty significant at this point in time. In fact, the Bank Nifty is also, the gains are getting shaved off a little bit. So that's the market for the time being. The mid-cap index should pull that up. We haven't mentioned that in a while, that the broader market is seeing a fair amount of pressure as well. The mid-cap index has fallen a lot more than the Nifty, and the advanced decline ratio is quite weak. So weak morning is what we have. Quick break. We'll come back on the other side, and then we will be in conversation with Pavitra Shankar, MD of Brigade Enterprises, to talk about how trends look after Q4. Welcome back. As promised, let's get that conversation going with Brigade Enterprises. Pre-sales for the company zoomed 46% sequentially, came in close to 2,150 crore rupees. Volumes jumped by about 58% as well. Realizations, however, now that was the only sort of, you could say, maybe a bit of a dampener in the numbers because they were down about 8%. Pavitra Shankar, MD of Brigade Enterprises, is with us. Pavitra, morning. Great to have you on the show as always. So looking very, very strong to round off the year. Just tell us a little more about the quarterly trends and also this dip in pricing. How should we read into it? I mean, is this some sort of a top or what sort of led to it?
I'll address that first very quickly. So the realization that we shared for the quarter is reflecting the product that we sold this quarter. This quarter, we launched a plotted project in Bangalore, pretty much sold out the entire phase in the same quarter itself. So that is why you see a slight dip in the realization only for this quarter. But if I look at it quarter on quarter, in terms of the previous year, Q4 FY23 to Q4 FY24, the overall realization has grown more than 30%, 30%. And in the annual year realization, it's a growth of 23%. So it was really just a quarter, effect because of the product that actually got launched and sold in Q4.
Okay. Fair enough. So it's more of a product mix issue. Just talk about the Q4 pre-sales. How much of it was from new launches and how much from existing ones? And just give us a sense of the inventory levels as well now.
Yeah, so our Q4, similar to FY23 and FY24 as well, a lot of our launches got sort of back-ended into the last couple of quarters and specifically Q4. So overall for the year and as well as for the quarter, about 50% of our numbers came from new launches. And I think that's just something we've been seeing across our portfolio and maybe across industry as well. A lot of the launches tend to come towards the second half of the year. But overall, we're seeing a really strong demand from customers. We see that continuing. We do have a very strong pipeline for the coming year as well. We have some launches coming up in Q1 itself that RERA's come in, and we're working on that right now. So we are seeing very strong demand from customers, even in terms of acceptance of the pricing of the product, not just in terms of projects that have already been launched, we're able to take up pricing there. But in terms of the product that also Brigade is going to launch over the coming year, there is some much higher end product, and therefore we intend to see the increase in average price realization as well for the year.
Okay, so since you were mentioning yearly trends, let me just sort of get there. You ended the previous fiscal at a sales volume of about 7.3 million square feet. Sales value was up 49%, and your realizations anyway improved even in FY24. There was a big jump in realizations, and now you're saying that more premium launches perhaps will improve that. So some numbers, maybe some guidance on any of these counts, sales value, realizations, and overall volumes that you're hoping to do this year?
So I'll just give you an indication of maybe the new launches that we're coming up with. The average price realization for those on average as a total product should be around 10,000 rupees a square foot on average. Currently, we're showing around 8,200 for the portfolio. So that's where we see the pricing levels, they should increase. But naturally, the numbers that come in every quarter will depend on the inventory that has moved in that quarter. But when we're looking out in terms of the new projects that are launching, we're seeing at an average of 10,000 rupees a square foot. This is driven by the upcoming launches that we have in Bangalore, Chennai, and Hyderabad, where we have 3 marquee projects coming up, where each of them will be launched at 10,000 rupees plus, and in Chennai, possibly 20,000 rupees or more.
Okay. So in terms of expansion plans, what are we looking at over the next, say, 1 to 2 years? What are the various partnerships that you have perhaps signed or are all set to sign? And where do you see the scope geographically as well?
So, we've always been communicating our focus on continue doing that. A lot of our new acquisitions in land bank are in Bangalore, Chennai, Hyderabad, a little bit in Mysore. We are going to reiterate our focus on these markets. We can get into them not just from residential, but also office, retail, and hospitality as well. So we like these 3 markets because they're very strong from an economic perspective as well. We know there's a lot of chatter about other markets, but this is our strategy and what we'll be focusing on. In terms of partnerships, we're looking at both JD, so joint development, as well as outright purchases for our land banking strategy. Approximately, give or take, we're around 50-50 between both of them. Currently, in terms of other equity level partnerships, we have one partnership with GIC, but looking out, we are fully and well capitalized to continue doing things on our own, but always open in case terms work out with any private equity or any other partners in case we're looking for growth on that front.
Okay, and in the retail portfolio, I want to understand, in the office rentals rather, what is the kind of exit rental that you did in FY24 and what is the scope of growth in FY25?
So for our leased portfolio, which includes office retail and office and retail, the revenues that we did was around 940 crores. And we expect to see that maybe as on an exit rental basis of around 1,050 crores, but that would require lease up of some additional space and some of that rental to come into the cash flow stream as well. So we're looking at something like an FY26 exit rental of and stabilized rental of around 1,050 crores.
Pavitra, just to go back to the, the housing segment, I believe you had put out a guidance of doing 10 million square feet by FY27. But looking at the launches, the whole pipeline and the buoyancy in the market, could you achieve that earlier? What's the expectation for FY25?
So we're working towards that. Look, it's heavily dependent on launches coming into the pipeline. If that happens, I think current market conditions definitely support, getting to that 10 million number sooner than we had originally indicated. It is dependent on when we get these launches coming in, but once that does happen, we are quite confident that we'll be able to move the inventory, but also at a pricing that makes sense for us, so that we're not simply, selling to get to some kind of number, but it makes sense from a project profitability standpoint as well. So hopefully sooner than FY27, but a lot of things need to fall into place for that. But we do have the projects and the land bank for us to get there.
Okay, and just on pricing, because you mentioned that some of the new launches that you're doing are over 10,000 rupees a square foot. So blended level, again for the year as a whole, last year you ended close to 8,000, just under 8,000. So overall blended pricing, what should we expect? 9,000 for this year? I mean, everything put together?
Yeah, I think it will heavily depend on how much inventory is being moved from the high price launches. So again, I think we will be aiming north of 9,000, but we'll have to see how that works out in terms of when the launches come in and which quarter they start hitting. But even in Bangalore, where predominantly the market was maybe, like a 6,000 to 8,000 rupees square foot kind of market, it has dramatically increased. And maybe across all our projects, we're able to launch at least 2,000 rupees more than that. So I think overall, I think we can push for a quarter on quarter above 9,000, but it will heavily depend on that inventory mix that gets transacted in each quarter.
Okay, we'll let you go on that note. Thanks a lot for joining in. I appreciate your time here. Well, with that, it is curtains down on this edition of Bazaar from the entire team. Thanks a lot for watching. The Nifty is down about 100 odd points, but the Bank Nifty is the one that's supporting the most this morning. Chartbusters coming up in just a bit.
Imami surges on a strong fourth quarter performance and extended winter aid sales while margins expand by 270 basis points at the gross level. Brokerage Jefferies issues a buy call with a target price of 630 rupees, citing improving outlook and attractive valuations. IRB Infra slumps over 7% after 4% equity worth nearly 2,000 crores changes hands. Likely promoters have been the sellers, whereas KFin Technologies also corrects in trade after over 6% equity changes hands at 720 rupees per share.
Lemon Tree Hotels gains after posting strong set of numbers in the fourth quarter. EBITDA rises 22%, although margins slightly lower in the fourth quarter.
Edelweiss Financial corrects over 12% after the RBI imposes curbs on two of its arms over supervisory concerns. Edelweiss ARC and Edelweiss Finance clarified that the measures will not have any material impact on the business.
Alchem Laboratories slumps on weak fourth quarter numbers. The brokerage Jefferies, Macquarie and BofA all issue underperformed ratings on the stock. Hello and welcome to Chartbusters. I'm Nigel D'Souza. Joining me as always is Mangla Malu. Well, it's that sort of a day, right? Getting into a big weekend where you'll get cues coming out of the exit polls. You'll have the OPEC meeting and you'll have inflation data from the United States as well. Ahead of that big weekend, it seems some lightening of positions is taking place. Explains why the markets are now virtually at the low point of the day. The good news, though, is that the Nifty Bank, that's holding one end up, still up, close to around 200 points odd. Mangla.
Nigel, Nifty Bank is holding up. The second half will be extremely crucial to watch out for. With this 125-point decline that we've seen, we've all but eroded the little gains that we had seen for May series itself. Going into today's trading session, the Nifty was up around 134 points for the May series, now down 126 points in today's trading session. But, just this move does not capture the entire volatility that we saw in the May series.
Well, that's right. And just keep an eye on the bottom of the screen. Positioning was such getting into Cummins numbers. There was delivery-based buying, there was long build-up as well. But now the commentary is not matching those numbers. The margins came in at 23%. The street liked it very, very much. But the management is saying that exports did not grow in any market in FY24. And they're saying there are signs of weakness even in the time to come with regard to their exports. So that's a bit of a problem pocket. And if I got that right, there was a bit of a one-off that took place in the past quarter, which explains why the margins went to around 23%. So the numbers still better than expected, but this commentary is not very, very great. And that explains why the stock is now at the low point of the day, Mangla.
Absolutely, Nigel. So that's about Cummins. But just keep an eye out on a new listing now. We have Office. That is the stock that listed the workspace solutions provider. Made its debut on D Street, listing with gains of about 13% to its issue price of 383 rupees. Thereafter saw some extended buying, so now around 17% higher from its issue price. Amit Ramani, the chairman and managing director of the company, now joins us from the exchanges. Amit, congratulations. It's a big day.